In today's episode of the Daily Brief, I'll talk about two interesting stories. I'll first talk about marine insurance and what's happening with it right now. And then I'll talk about RBI facing a monetary policy dilemma. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Krishna, and today is Friday, the 6th of March. Earlier this week, when bombs fell in the Persian Gulf, one of the first things the market was worried about was oil. After all, the Strait of Hormuz handles more than a quarter of all seaborne oil trade and roughly a fifth of the world's LNG. We covered this a few days back. But what actually stops oil-laden ships from moving isn't missiles as much as it is, quite literally, a piece of paper, or more precisely, the absence of one. Perhaps the saying, "the pen is mightier than the sword," couldn't come any closer to being real than this. Now that piece of paper is marine insurance, and we found that what is otherwise a set of financial and legal jargon is worth its own Daily Brief story. So let's dive in. You see, a ship doesn't move just because there's cargo to carry. It moves because an entire chain of promises holds together. The ship owner promises the charterer the cargo will arrive safely. The charterer gives their word to the cargo owner that the goods are protected. And the cargo owner assures the bank financing the trade that the shipment is covered. Insurance is what makes all of these promises believable. Now, without all of these, the chain falls apart. If the cargo isn't insured, banks won't issue the letters of credit needed to guarantee payment in global trade. Ports won't let uninsured vessels dock. Even the ship's own crew can refuse to sail. It's not so different from how you can't drive a car without motor insurance, except the stakes are vastly higher and the rules much stricter. See, moreover, marine insurance, unlike health or a term plan, isn't one policy. It's a stack that covers various things. Now at the base, you have hull and machinery insurance, which covers the ship itself. Think of it as a vehicle's own insurance. Then there's cargo insurance, which protects the goods being shipped. Now on top of that sits protection and indemnity, or P&I. If the ship causes pollution, injures crew, or damages someone else's property, P&I covers it. Now interestingly, P&I isn't run by for-profit insurance firms, but by mutual clubs that are run by ship owners or ship operators themselves. 12 major clubs, who collectively call themselves the International Group, cover roughly 90% of the world's ocean-going tonnage. And then layered on top of everything is what's extremely relevant today: war risk and political risk insurance. You see, in normal times, war risk is part of the package. You pay a modest annual premium and your ship is covered for missile strikes, mines, and other hostilities. But there's a catch. War risk policies come with a cancellation clause. Typically, insurers can pull the cover with just 7 days' notice. In situations involving a major military power like, say, the US, that window can shrink to as little as 72 hours. Now, this might sound unfair, but think about it from the insurer's perspective. War is not the same as a sea storm that might leave a single ship stranded. If a conflict breaks out near a major shipping lane, dozens or hundreds of ships are exposed simultaneously. A single event could trigger billions in claims all at once. No insurer can stomach that kind of concentrated risk for long. So, the deal is pretty simple. During peacetime, we'll cover for you. But the moment things escalate, we reserve the right to walk away. And that's exactly what happened recently. In late of February 2026, military escalation between the US, Israel and Iran sent shockwaves through the Gulf. The Strait of Hormuz, that narrow corridor between Iran and Oman through which a staggering volume of the world's energy supply flows, became in the eyes of insurers a place where the risk calculus had changed overnight. Now most marine insurance deals are brokered in what's called the London market. Think of it as a specialist hub where insurers and reinsurers handle big, complicated risks. If a ship is insured, chances are the deal passed through this market. Inside the market sits the Joint War Committee, a group of representatives who will underwrite marine hull war risks. This committee maintains a list of areas considered high risk. When missiles started flying, the designated list expanded. Waters around Bahrain, Kuwait, Oman and Qatar were added to the list. Now that designation matters enormously because it triggers a separate pricing regime. Instead of paying just your annual premium, any ship entering a listed area now has to pay an additional war risk premium, typically quoted as a percentage of the vessel's insured value. And those premiums moved fast. Insuring a $100 million vessel for a Gulf transit reportedly jumped from around $250,000 to $375,000 per voyage. Now that's a 50% hike, and in some cases quotes were even higher. But beyond the price increases, cancellations took place left and right. Multiple major insurers like Guard, Skull, London P&I Club and so on cancelled or paused war risk cover for vessels in or near Iranian waters effective March 5. Japan's MSNAD suspended underwriting for war risk policies across the region entirely. One insurer mentioned a buyback option, meaning you could get your cover reinstated but at a significantly higher price and on tighter terms. Over 200 vessels ended up anchored in or near the strait waiting. And here's the cruel irony. If a zone is dangerous and your insurance just got cancelled, wouldn't you just leave? But you can't. You see, sailing out means transiting through the very waters your insurer just declared too dangerous to cover. If something happens during that exit, a missile, a mine, even accidental damage, the ship owner is fully exposed. No one's taking that gamble with a vessel worth tens or hundreds of millions of dollars. And even if a ship made it out safely, ports won't accept vessels without valid insurance documentations, banks won't honor letters of credit if the paperwork is out of order, and the act of sailing through a war zone without war risk cover could void the ship's other insurance policy entirely. So, ships sat there burning money on fuel and crew costs, unable to move until cover was reinstated or the situation changed. The traffic through the Hormuz Strait collapsed. Freight rates surged as VLCC, very large crude carrier charter rates to China, reportedly exceeded $424,000 per day. Now it's important to note that insurers who cancelled cover didn't necessarily want to. Many of them were forced to because the layer behind them, reinsurance, was pulling back. Now reinsurance is insurance for insurers. It's the mechanism that allows an insurance company to write a $100 million policy on a ship without bearing the entire risk itself. The reinsurer takes a position of that risk off the insurer's book, which gives the insurer the capacity to cover more ships. Now this arrangement is powerful but also has a dependency. When reinsurers get nervous and the war risk is exactly the kind of unpredictable exposure that makes reinsurers nervous, they shrink their capacity. And when reinsurance capacity shrinks, insurers have no choice but to raise prices, tighten terms, or cancel outright. Take what GIC-RE, a state-owned Indian reinsurer, did. It pulled back from its marine hull war risk cover from multiple high-risk zones from March 3 effectively, including the Persian Gulf, Gulf of Oman, and parts of the Indian Ocean. And it didn't stop at the withdrawal. GIC-RE warned that any vessel transiting, calling at, or even dry docking in specified zones after the cutoff date would be treated as a breach of warranty. In insurance terms, a breach of warranty means your cover ceases to exist. All those marine insurance companies that were being reinsured by GIC are now left on their own. Now this starts an unstoppable chain of events where one topples over another. Ship owners won't risk sending a vessel worth tens or hundreds of millions of dollars into a zone where they are uninsured. Charterers can't fulfill contracts. Banks won't finance shipments without valid insurance documents. As ships pile up outside the affected zone, ports start congesting. Freight rates spike because available shipping capacity shrinks. Commodity prices rise because delivery timelines become uncertain. And then the cycle feeds on itself. Higher values at risk and greater uncertainty make insurers even more cautious, which further restricts capacity, which pushes more ships to the sidelines. Now, it wouldn't be wrong to say this also trickles down to inflation in commodity prices eventually, and this makes trade prohibitive. Now, this all isn't theoretical. We have seen this pattern play out before. For instance, during the Iran-Ukraine tanker war in the 1980s, commercial tankers were repeatedly targeted and insurance markets responded with sharply higher premiums. And in late 2023, in the Red Sea, Houthi attacks pushed war risk premiums. And when attacks escalated further, premiums reportedly hit 1% of the ship value, meaning $1 million per voyage for a $100 million ship. Traffic didn't stop, but it collapsed just enough for carriers to reroute around the Cape of Good Hope, adding weeks and enormous cost to the journeys. Now, President Trump has reportedly proposed offering government-backed political risk insurance and financial guarantees to shipping companies operating in the Gulf. This echoes historical precedents in the Iran-Iraq war. For example, the US Navy escorted and protected tankers through the Gulf. But there's an important distinction here that's easy to miss. Political risk insurance covers government and sovereign actions, things like expropriation, political violence, or currency transfer restrictions. War risk insurance covers missiles, mines, and direct hostilities. They're not the same product, and a political risk policy may not substitute wholly for war risk cover. This, perhaps, is why insurance costs surged 12 times even after the Trump guarantee. Now, even if the backstop is structured correctly, there are practical questions. Does it cover all vessels or only US flagged ones? Does it apply to P&I liabilities or just hull damage? Can it be activated quickly enough to matter given the cancellation notices are measured in hours? And critically, will reinsurers treat a government guarantee as sufficient to restore their own appetite, or will they remain cautious regardless? Now, a state backstop helps at the margin, but it doesn't get the market to flip on their consensus that the new risk is too correlated and too volatile to bear. You see, marine insurance is invisible when it works, but catastrophic when it doesn't, and war is a risk like no other. The crisis in the Gulf has shown how thin private risk appetite can be, but in some ways it is justifiably so, because how do you put a price to the war? And even when the immediate military tension reduces, the question won't be whether the shooting has stopped. It will be whether the Joint War Committee still lists the area as high risk, whether reinsurers are willing to restore capacity, and whether premiums come down enough for the economics of transit to work again. Until all of those boxes are ticked, trade through the Gulf stays frozen. You see, India's economy has always been and still is founded on the base of its banking system, unlike in advanced economies like the US or Singapore, where capital markets play an outsized role. See, when a business in India needs to raise funds, it walks into a bank branch first. So if there's any decision to be made on monetary or fiscal policy, the central bank of the government largely expects our banks to cooperate. When RBI makes the rate cuts, for instance, the expectation is that the banks will pass those cuts on, making credit cheaper and more plentiful. Rather, they don't always have the incentive to do so. We have covered before about how even after the RBI's rate cuts, transmission to actual lending rates was sluggish. We've also explored how high inflation expectations can blunt the effect of rate cuts. But what about the banks themselves? What makes some banks more responsive to RBI signal and others less so? A paper by researchers at Indira Gandhi Institute of Development Research, Rajeshwari Sengupta, Harshvardhan and Akhilesh Verma, digs into one specific factor that shapes how well monetary policy works: the capital sitting on a bank's balance sheet. Their findings reveal an interesting dilemma in the Indian banking. So, let's dive in. When the RBI raises short-term rates in an attempt to control bank lending, well-capitalized banks don't respond strongly. In fact, they continue lending at strength. But before we get into all of this, what does it even mean to be well-capitalized bank? Now think of a bank's capital as a financial cushion. It's the money that belongs to bank shareholders as opposed to what it owes to depositors or bondholders. This also includes retained earnings or reserves that the bank has created. Now the simplest way to measure this is the bank capital ratio or BCR. It is the ratio of a bank's capital and reserves to its total assets. A bank with a higher capital ratio has a thicker cushion to absorb losses more easily and is therefore less likely to fail. Now that sounds like an unambiguously good thing, and for financial stability it is. But the IGIDR researchers argue that this stability comes with a contradiction. Say the RBI is worried that banks are doling out loans a little too much. And to cool down the economy from overheating, the RBI raises rates. Higher rates mean that borrowing costs rise for banks and therefore lending. But a well-capitalized bank has a buffer. It can absorb the higher cost of funds without panicking. It doesn't need to cut back lending just because rates went up. It has the financial strength to keep the credit tabs open. A weakly capitalized bank, on the other hand, doesn't have that luxury. When the rates rise, it feels the squeeze immediately, its margins shrink, its risk appetite contracts, and it pulls back on lending, exactly as the RBI intended. In an interesting paradox, well-capitalized banks are far less sensitive to rate increases, while banks with thinner capital cushions respond more sharply as per the RBI's expectation. And India, banks that are often well-capitalized tend to be among India's biggest, most important banks. In its role as a banking regulator, the RBI does want banks to be well-capitalized, That's what keeps the system safe. But as a monetary policy maker, the RBI also needs the big banks to respond to rate changes. Strong banks are stable, but they're also stubborn. Now, to test this, the researchers assembled data spanning between 2002 to 2018 from 18 Indian commercial banks, both public and private. They tracked the relationship between short term interest rates and how much credit banks supplied. The key question: does a bank's capital ratio change how sensitively it responds to monetary policy? A 100 basis point increase in the short-term rate, specifically the weighted average call rate or WACR, leads to roughly a 1.1 percentage point decline in credit growth across the banking system. Now that's a monetary policy working as intended. But banks with higher capital ratios show significantly less sensitivity to rate hikes. For every percentage point increase in a bank's capital ratio, the negative impact of a rate hike on its credit growth is reduced by 0.03 to 0.05 percentage points. Now that might sound small, but when you consider that private banks in the sample had an average capital ratio of 11.7%, while public sector banks averaged just 5.6%, the differences compound quickly. Well-capitalized banks were essentially shrugging off monetary tightening, while their less capitalized peers were doing the heavy lifting of transmitting the RBI signals to the economy. Now, to sharpen the picture, the researchers split their sample into high capital and low capital banks. For well-capitalized banks, the relationship between interest rate hikes and credit growth was insignificant. Rate changes barely moved the needle on their lending. For banks with low capital ratios, the relationship was strong and negative. When rates went up, these banks cut lending meaningfully. Perhaps the one thing that seems clear from this is that private banks with their higher capital ratios are far more insulated from rate hikes than public ones. The researchers found that for private banks, their capital cushions were genuinely protecting their lending from rate hikes. For public sector banks, though, the effect was statistically insignificant. Now, this makes intuitive sense if you look at how these two types of banks raise funds. Private banks go to the capital markets, typically raising large amounts at strategic intervals to sustain lending over 4 to 5 years. They tend to maintain capital ratios well above regulatory minimums. Public sector banks, by contrast, rely on government capital injections, which are just enough to keep them above the regulatory floor. During the 2014 to 2018 NPA crisis, for instance, the government poured around 4 trillion rupees into PSBs to prevent them from breaching minimum requirements. This was funding purely meant for survival. Now the story doesn't end there either. The researchers also found that asset quality dramatically changes the picture. Between 2002 to 2013, on a relative level, banks didn't have a lot of NPAs and their books were relatively clean. That's when the capital buffer worked exactly as predicted. Well-capitalized banks absorbed rate hikes and kept lending. But between 2014 to 18, banks' balance sheets were burdened with NPAs. This was a period when the banking system was rocked by debt crisis among many infrastructure players like Bhushan Steel, SR Group, JP Group and so on. We also covered this crisis briefly with our story on DHFL. In this period, even well-capitalized banks started pulling back. Now the reason is obvious. When a loan goes bad, the bank has to set aside provisions to cover potential losses, which erodes its effective capital. During the NPA crisis, many banks reported capital levels overstated their true financial strength. The cushion was there on paper, but it was being consumed by bad loans in practice. There was hardly any space for the capital buffer to absorb monetary policy. So far, we have talked about what happens when the RBI raises rates to curb lending, but what about when the central bank cuts rates to simulate lending? A 2016 paper by researchers from the Bank for International Settlements sheds lights on this. Their findings look like they flipped the first paper on its head, yet are actually consistent with the paper's finding. The BIS researchers found that well-capitalized banks respond much more vigorously to rate cuts. A 1 percentage point increase in the capital ratio was associated with 0.6 percentage points of additional annual lending growth. The logic behind this is that better capitalized banks pay less for their own funding, roughly 4 basis points less for every 1 percentage point increase in their equity ratio. Depositors and bondholders see them as safer, so they demand lower returns. Lower funding costs mean more room to lend. Now, this was particularly relevant during the post 2008 period when central banks around the world were desperately trying to restart credit creation. The banks best positioned to expand lending when rates would fall were the well capitalized ones. The weakly capitalized banks, burdened by losses and fearful of further deterioration, wouldn't lend even as money became historically cheap. Now, is this a contradiction with the IGIDR paper? Well, not really. In fact, they agree on the effect of a rate increase on well capitalized banks. The insight from Indian banks does to some degree apply internationally as well. Both papers agree that either which way, a bank's capital is an extremely useful buffer. Poor capitalized banks, meanwhile, cut lending when rates rise, which is good transmission, but they also fail to expand lending when rates fall, which is bad transmission. But where the two papers differ in nuance is to subject of the analysis. IGIDR focuses entirely on India, a developing country with a financial system where banks dominate over capital markets. If the RBI's decisions aren't effectively transmitted through banks, there are few avenues to ensure those transmissions work. In contrast, in more developed countries, if banks don't work, monetary policy can still channel its effect through capital markets. For emerging markets, this represents a difficult trade off. As India grows economically, the private sector will take up a larger role in the system. In turn, that will mean that bank capital will become an increasingly more important factor in the monetary policy. Accordingly, the RBI's toolkit may need to adapt. It may have to rely less on the assumption that rate changes will automatically flow through the lending and more on complementary levers like liquidity management, macroprudential regulation, and so on. Monetary policy, as we keep rediscovering, is only as effective as the institutions that carry it out. Now, coming to the tidbits. India's services sector growth eases in February, the slowest growth pace in over a year. The HSBC India Services PMI slipped to 58.1 in February from 58.5. On the bright side, international sales rose at their fastest pace since August and the composite PMI climbed to 58.9, the strongest private sector expansion in 3 months. China lowered its 2026 growth goal to a range of 4.5% to 5%, the first formal downgrade since 2023. This is China's lowest target since 1991 as it grapples with deflation, a property slowdown, and rising trade tensions. The budget deficit target stays at a record 4% of the GDP as the government expects to maintain its fiscal spend in order to support demand. PNGRB, India's petroleum regulator, is preparing to propose building storage facilities near India's 8 existing LNG terminals for both commercial use and strategic reserves during emergencies. The move comes as tanker traffic through the Strait of Hormuz has ground to a near halt following the Israel-Iran conflict. That's it for this episode. See you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.